my strategy with precious metals, with physical precious metals, is to have an equivalent of 2 years worth of my lifestyle burn rate converted into physical gold and silver.
Hello there, my friends. Chris Marcus here with you for Arcadia Economics as we continue on in early January with repo lines, investigations into precious metals, and all sorts of fascinating things that happen in today's financial markets. So before we get started, go ahead and hit that subscribe button, and I'll do my best to keep you posted. Because as you can see today, fortunate to be joined by Lior Gantz of Wealth Research Group. Lior is calling in from Tel Aviv and obviously is quite active in the market, speaks to a lot of really smart folks and is quite a smart one himself. So Lior, pleasure to have you on here today. And how is everything going with you?
Thank you for having me, and everything's going well. Excited to have a chat.
Yeah, well, I was happy to catch a couple of your recent interviews. I know you spoke with Ted Butler and you were on Patrick's Silver Bullion TV, and obviously we have a lot of silver fans in our audience here. So perhaps just to kick things off, be curious what you're seeing in the silver market and maybe some thoughts for folks on how to approach this tricky to trade market and any insights you could offer there.
Definitely. First of all, I personally bought about 2,500 Silver Eagles last year myself, and I bought my last round of gold Eagles in September of 2018. The price was 1,180, and it was actually 3 days after it bottomed. The last time it really bottomed. So I caught a good time for the last purchase of gold Eagles, and last year I bought Silver Eagles around June, so it was actually a good time as well.
Yep.
And my strategy with precious metals, with physical precious metals, is to have an equivalent of 2 years worth of my lifestyle burn rate converted into physical gold and silver. So what I do is I take the family burn rate, the cash burn rate, my expenses, mine's and my wife's, my daughter's, whatever the family unit is, and I multiplied it by 24, and that's basically the amount that I converted into fiat, from fiat into precious metals, into physical gold and silver. And I did that a while back, and then obviously with every addition and to the lifestyle, etc., I revise it either up or down. Fortunately, it's been up over the years, but that's the idea. And the thesis behind it is that if there's a prolonged depression, if there's a recession, if there's something that lasts about 2 years, then I have stored or saved up 2 years worth of today's money, which in a recession or in a depression could be actually worth more in purchasing power,
Right.
because prices tend to go down. I wrote about all of this strategy at wealthresearchgroup.com/gold playbook, which talks about all the different ways to invest in gold and silver. I think what's most interesting, Chris, is that gold has actually been one of the best performing assets of the past 20 years. So of this millennia, of the century, even though it's a non-performing asset. So it doesn't pay a yield, doesn't pay a dividend. It actually has a negative cost to it if you store it. But with all of these drawbacks, it's still been able to outperform many of the performing assets, which is very unique, because if you look at the S&P 500, or if you look at stocks in general, about 30 to 40% of the return is either buybacks or dividends, or put together. So price appreciation tends to be about a 7% a year on stocks over time, and then the dividends tend to be about a smidge that helps you get to that 9 or 9.5% if you compound over time. And I think it's very unique for gold to be going from 250 an ounce to about 1550 as we do this interview in this time span, uh, because it shows you that there's a real change in how investors perceive uh, non-performing assets such as gold, and you can see it with Bitcoin. Obviously, if you were to tell someone logically, hey, there's a coin that is totally virtual, it has no use, no real world use, it's not jewelry or anything like a conductor like gold is, it's not a semi-industrial metal like silver is, yet if you want to purchase one of these babies, you'll have to part ways with $8,800.
Right.
And the reason is it's just because it's outside of the banking system, and then you can own an asset that's outside of the traditional fiat system. If you were to tell someone that 20 years ago, he would not buy that. But today, you have an asset that's worth over $130 billion and trading every day between people across the world. So we do live in a world that is much different than the one that we entered into about 20 years ago. And therefore, if 20 years ago, uh, you know, gold or anything that's non-performing would not have been a great asset to own, because uh, why own something that doesn't perform, uh, and you have to bet that somebody else would pay more for it. Well, right now you can bet that somebody else would pay more for it, because the trajectory of all fiat currencies has really been downwards, except for the US dollar in the past 8 years. Gold is at an all-time high versus the euro in terms of if you price in euros, it's at a 40-year high versus the yen, and that's and the 40-year high is just because in 1980 it was like a super bubble for gold and yen, but we're back to those levels, the 1980 levels for gold and with the yen. It's at an all-time high with about 70 other fiat currencies around the world. It's not at an all-time high with the dollar, and the reason is that the dollar has been at its own bull market for the past 8 years, and that's really interesting, right? Because you see Bitcoin and gold rallying up while the dollar is having very good years. You're seeing virtually no broad inflation. So there is inflation in education, there's inflation in tuition, there's inflation in certain pockets of the economy, but it's not what we call a general inflation where prices just rise across the board. So we have low inflation, we have a strong dollar, we have a roaring stock market, which historically is not a good um, correlation to gold, and um, you have a recovery. So with all of this, gold shouldn't be at 1550, yet it is. So I think that's one reason why in the past year I've also been looking for ways to invest in precious metals that are outside of this 2-year strategy, that is more of a safe haven insurance type for rainy days. We've seen some very reputable companies in 2019 that have doubled in price.
Yep.
So we've been very fortunate to take part in that in the bull market for mining companies. That's been going on for 7 or 8 months now, and with great returns. These companies have doubled this year, while the S&P 500 has gone up a fair amount, like 30-35%. And some companies have gone up nearly 100 once, which is what I like about the mining space. You can take the blue chips and you don't need anything else. You don't first majestic silver types, and you know that they have very good leverage to the price of silver for in this example, and they double. Um, so I think it's been a very good year, 2019 for precious metals, and I think 2020 is going to continue in the same manner. The same underlying principles and fundamentals and catalysts for gold and silver to continue higher are there. In fact, If anything, after the trade deal, there's a lot of room for commodities in general to go higher. Reason is that I think officially the dollar, I think it's officially peaked. The dollar as a safe haven is no longer that needed. The risks of the threat of tariffs has been greatly diminished, reduced. By the time this interview airs, I think we will be past the 15th of January, the phase one deal. Whether or not it's a big deal in size and scope is not the point. The point that there's a wet ink between two of the world's the two largest economies in the world, representing about 40% of global GDP put together. That's a huge deal. It's very pro growth, and it also helps to understand, Chris, that the dollar is not needed by the Chinese anymore. Once you have a trade deal, you don't need to create that balanced deficit where the Chinese hold a disproportionate amount of treasury debt. And I think you'll start seeing an unwinding of dollars in terms of the Chinese. Is inversely correlated with the price of commodities, especially with gold, silver, and oil, for example. So I think that's the backdrop for 2020. I don't see anything major happening with stock returns. Many people think that we're in a bubble for stocks. We are really not. We're in an expensive stock market, but it's definitely not a bubble stock market.
Yeah, a lot of interesting points you mentioned in there, Lior. And perhaps, I guess, in terms of the bubble, or whether we're in a bubble or not, I guess, how do you factor in the effect of the low interest rates? Now we have the repo lines where, don't call it QE yet, they have more money than QE going in. So I've been of the school of thought that if you remove that, then you would have some problems. So curious, how do you factor that into investing in the stock market right now?
So the article that I published yesterday, it had to do with, it was actually about the transcripts that were declassified from the Fed from the 2012 meetings and the 2014
Right.
meetings, where Jerome Powell himself says, look, we're expanding the balance sheet too much. Once we start shrinking it, and this is so prophetic, because he said once we start shrinking it on autopilot, at some point the market would not like it and we'll have a moment. And that moment was December of 2018, when in 1 month the S&P 500 dropped by 19.2%, and intraday it actually dropped more than 20%. So I think what you're talking about, the repo markets, or the expansion of the balance sheets by $400 billion since September, it has a lot of effect on markets, and interest rates have a lot of effect on market. The reason being that if you take the dividend yield of the S&P 500, which, like I said, historically is about 40% of returns, in the last decade it's been much less than that. It's higher than the yield on the 10-year Treasury. Historically, that's very rare for the S&P 500 to yield more than a safe haven 10-year bond, which is the barometer, the measuring stick for all asset classes in the world. Everything is based off of the 10-year Treasury yield. So for for the S&P 500 to still yield, have more of a yield for investors than the 10-year, it's very rare, and means that stocks have a lot more to go. In other words, stocks are as valuable as they are, or as expensive as they are, not because the future returns on them are projected to be amazing, but because the alternatives for investors are very few and far between. It's important to understand that though the individual investor, the retail investor, is not cashed up, and the consumer is not part of this bull market. So 180 million Americans have zero exposure to the stock market. That's 55% of Americans. Most of the stock market, most of the money is either at the top levels of society or in pension funds. And both of these demographics, they do not hold a lot of cash on hand. So they are always at about 4.5 to 5% cash. And as they grow richer and richer, they will still put money into the stock market. There was a big scare that was called the demographic cliff, where there was a theory that boomers would take out money every single year for their retirements, and new money would not be able to come in to replace this, and this would cause a major deflation in the stock market. But buybacks were not factored in, and we have so much buybacks right now that actually that is the biggest driver of prices going up. And we also have a very robust middle class in China that's growing every single year. And they actually have a national mandate that they want to reach about $15,000 a year per income per person for the middle class. And a lot of those funds will end up owning our Microsofts, our Apples, etc., and will drive up um, the value of stocks. So, in the bottom line, what I'm trying to say is, as long as we remain in a world that the U.S. is an economy that is based on very low unemployment rates, like we do have right now, but also very stagnant wages because there's no corporate letters for many of these people. If you take the U.S. Jobs market, 150 million people are employed, 156 million people are employed part-time and full-time. About half of them, Chris, earn about 30K a year, and they're not in jobs that are projected to double or something. They're not climbing a ladder. They're either dead-end jobs or service type jobs. The, the career paths for many Americans are pretty much dead ends. And I think as long as that remains the way that the free market operates in the U.S., the private sector, where the the medical industry, so doctors, etc., earn a lot of money, but you need many years to get to those higher level salaries, and then tech uh, and everything that has to do with technology earns a lot of money, but then the the majority of the people that service these two industries are basically in services and do not climb a corporate ladder. As long as we have that system, I think that the U.S. Will have a problem where stocks will remain expensive because the top echelons of society, they own stocks and they have no other alternatives to stocks. You can actually uh, diversify out of the stock market and go into real estate, but the real estate market isn't that big um, for individuals to as easily put money in there as it is with stocks.
Yeah.
So stocks will remain very, very much an asset that is not only um, bought for the appreciation, but is also bought because of the lack of alternatives. What can change this is if the U.S. starts to experience higher inflation, and that has just not been the case thus far. But um, you, what you what you start to see is that the unfunded liabilities in the 2020s, the decade that we've just entered, they are starting to become a noticeable problem, not just something down the road, but something that creates $1 trillion annual deficit that you really have to monetize in a way that is
Yep.
just um, bigger than just issuing more bonds. The appetite for treasury bonds um, by foreign investors is just not going to be there with the $1 trillion deficits as much as it was up until now. So you are going to see that point where domestic lenders, retail Americans, and the Federal Reserve have to monetize debt. And when they do that, that starts to create that process of inflation because you have an entire generation, the millennials, that have not formed families and have not bought housing yet. They will start to create velocity of money in the economy. I think that entire storm of 78 million people that are starting to form families, and with the baby boomers retiring and inheriting the millennials inheriting the higher paying jobs. So they are dead end jobs, but some of these millennials are going to inherit very high income jobs in about 5 to 6 years. They're going to see a big boost in their income, and that's all going to get priced in into inflation very, very soon. Because if you know that your next job is uh, getting a big raise, you start to make plans in advance. You start to originate mortgages, and you don't mind doing some things in advance because you know the path that you're going to follow. I think that is one of the biggest catalysts to think about in the 2020s. The fact that the millennials have been underestimated for their power to create velocity of money because they only have 3% of the wealth in the United States, whereas the boomers have 60% of wealth. So I think they've been underestimated for their power to create velocity of money, and I think they will once they start to dumb down to lower down the burden of their student loans, and the banks will start lending mortgages to them. The housing um, industry will start coming back because we have a severe um, lack of housing in the United States right now. It's been underbuilt for more than a decade. I think those, Chris, are the fundamental contrarian catalysts for higher inflation in the 2020s. I'm not talking about 5 or 6 or 7% inflation, but I am talking about 2.5 to 3%, which is very problematic um, if you're the U.S. government and if you're a bond investor, because that will absolutely crater those bonds.
Yep. And Lior, last question I have for you here. I heard you mention something one of the interviews I was reviewing, which may initially sound not related to finance, although I think it's directly tied in. You were talking about habits and how it's good to read, but there's also the implementation of habits, which certainly as I grow older, I'm reading Benjamin Graham's The Intelligent Investor right now and really thinking a lot about that. So I thought it was a great point you mentioned, and perhaps maybe you could just talk a little bit about how you actually apply that to investing and financial markets and really preparing for your future.
Okay, I think that's a great question. I wrote a report at wealthresearcher.com /me, M-E, and it's basically the 16 life principles that I personally follow every single day as a matter of habit or as a matter of habits. Um, and, and those have worked well in my life. I think um, all professions are, are a matter of implementing some key habits that are proven to work in and then applying to them your personality.
Yeah.
So the real skill set that people have in today's world in order to be to get paid more, to be compensated, what the market really appreciates in today's world is thinking people more than doing people. Um, it, it, you know, for many centuries, people that knew how to do things were getting compensated. If you knew how to do some tricky things and some special things, you were getting compensated. We are living in a thinking world. If you contemplate for a second what high level executives do every day, they're getting paid to make 3 or 4 key decisions every
Yep.
day, and they're getting paid millions and millions of dollars. And the same thing goes with business ownership. What you um, need to figure out in your own life is how can you implement some basic principles at a very high level and tune out the rest. I think that's uh, where most people excel. They have the confidence to not worry about many of the things that other people worry about and not even think about them. Their minds are clearer, and that way they have more time to think. Um, I actually set time every day to think, which is very unique. A lot of people think it's like a waste of time or something, or it's an Eastern tradition. But in the Western world, if you have an hour a day to sit and really think deliberately about your life, you'll reach a greater level of confidence in yourself. I think you'll develop your personality better. Um, you'll be better focused. Your attention span will be bigger in what you want to achieve, and then a lot of things that you deem important, I think, will stop being that important, and you'll be able to focus on the things that you really want to achieve. Because if you take out 24 hours, 8 hours is like sleep, and you have uh, between consumption of food and all the errands you have to run, you don't have a lot of productive time if you don't focus on that time. And so what I've tried to do is I've tried to reach something called the 6 hour peak, where I make sure that every day I have 6 hours where I'm almost like an athlete running a sprint, and I'm at the highest level of what I need to achieve that day for about 6 hours. And I've seen that if you can do that, even 6 days a week, if you have 36 hours of amazing productive time every single week, you can do miracles. And then you really can enjoy and relax and do some cool stuff at the other part of the day. And what I think is important is if you do that for about 10 years, if you really grab a hold of that for 10 years, you reach a point where you have savings in a sufficient amount where then you can start buying productive assets like real estate and stocks to start um, siphoning that, where you don't need to apply so many hours to your income because assets do that for you. And that's basically the plan in today's world, because nobody gets to retire off of just savings and work. You you must own assets. People are living longer. If you really think about it, I'm 35. I'll probably live another 55 years. That's a long time, and you have to do that in a good shaped body in order to enjoy it. There's a lot of things you need to consider in today's world. This is a very unique world and a very unique time, and you can accomplish many things in one lifetime. Um, but if you're not effective, if you're not efficient, then man, this could be a disaster. So I think that's really my point. Uh, at any age, you can really make big changes because people get to live a lot longer. They get to change. Life changes around them much faster. So basically, you get to reinvent yourself many, many times in one lifetime, and that's a cool part of today's world.
Yeah, I love the answer you just gave there. As I get older, I hit 41 last year, but more and more, whether it's meditating or just thinking, and especially as you mentioned, there's the pros and cons. We have the internet where there is so much stuff out there, yet I find the more I get back to thinking, all right, what's really important to me and focus on that. And so I think that's a lot of great advice you gave in there. I will look forward to reading the /me article. It sounds like a good one, and we'll have that and the gold playbook linked below, which I think will be helpful for folks. And Lior, perhaps just in wrapping up, you can mention the website again and how people can find you and some of the things you offer.
Yeah, definitely. To stay up to date with everything that I'm doing, basically wealthresearchgroup.com is a free financial newsletter that you can subscribe to, where I publish two things basically: my macro outlook and what's going on with the economy on a grand scale, but then also we feature a lot of what I do personally with my own money. If I do any trades or any investments that I deem either high conviction or high risk, then I publish a lot of information about that. For example, in December of 2018, when the market dropped 20%, I issued a report with 3 stocks that I said would have the most aggressive rebound in the S&P 500, and they ended up being at the top 10 of the 500 stocks for 2019. that's a pretty good streak to have. And you know, through the year, we also uh, talk about smart speculations, like with mining stocks. So it's a mixture of both, and I do it. I love it. So it's been a great 3.5 years for the newsletter, and we'll have a great 2020 hopefully.
Well, that comes through what you said, that you love it. And I think often I find myself noticing, geez, if there's something we're not having fun doing or enjoying it, is it worth doing at all? So I think that's a big part of it. I appreciate you sharing that. Your passion does come through, and we'll have all those linked below. And again, thanks for joining me and sharing some of the great insight today.
Thank you, Chris. Thank you for having me.
So that is today's episode. I do thank you for spending some time with me and hope you enjoyed it. If so, go ahead and hit that subscribe button, and I'll see you again soon.